Welcome back. We are now continuing with a specific outcome number 2. In this session, we're going to look at develop a wealth preservation solution. Right, let's have a look at the first assessment criteria. Generic investment instruments are investigated with reference to the strength and weaknesses of each, and an indication is given of how each could be used to meet the specific needs of a client. So if we look at activity 1, I'm going to discuss here with you the following. Explain the various forms of planning you will need to do for a client in order to provide a holistic picture. Now, this is an important question and answer for the client. Every client has different needs during his lifetime. Some of these needs are as follows. Number 1, financial management, tax principles and optimization. That's to save as much tax as possible legally. Investment planning or asset management, risk management and insurance planning, retirement planning, estate planning and wealth transfer. That's at death and you need to transfer your wealth, and integrated financial planning. If we look at the rest of the activity, it is no longer feasible for the financial planner simply to evaluate the client's risk and add relevant risk benefits. So you can't just walk into a client, give him 100,000, 200,000 cover, and walk out. It's important that you do a proper portfolio, for the client. It's becoming increasingly important to provide the client with a structured investment plan detailing his long-term and financial objectives. An investment plan consists of a portfolio that will meet the client's investment needs over a specific period. So let's have a look in activity 2 at the various asset classes that we can use. Generally, the distinction is made between two traditional asset classes and non-traditional asset classes. List the traditional asset classes and list for me the non-traditional asset classes. So in your workbook, we're asking you to now make a list of these asset classes. The traditional asset classes typically are things like cash, bonds, equity, property. You can also add collective investment here. Your non-traditional asset classes is things like derivatives, currency funds, hedge funds, commodities, etc. So those are the ones that's not so well known, and that some clients actually need to stay away from because of the risk involved in, especially like derivatives and currency funds. Let's have a look at the various strengths and weaknesses of the following investments. If we look at cash, bonds, equities, collective investments, and property, we can see the strength of cash investments are a safe investment option. You are guaranteed that your initial capital will be paid back with the interest rate that you were quoted. Cash investments offer a stable short-term solution for your money at times when stock market share prices are moving up and down. Money market accounts in particular can offer a useful holding facility, especially for large lump sums while you decide what to do with your money. If you intend to use your money within 2 years, it's a better option than the long-term investments such as equities or property. Little knowledge needed to invest in cash investments, and not many dealing expenses is involved. But what is the weaknesses of a cash investment? Historically, cash has not managed to beat the inflation rate over time, so it's actually moving down in value more than growing in value. And then there's only an interest rate exemption of 23,800 Rand. That's now the 2023-2024 tax year for individuals under the age of 65. If we look at equities, the strength of an equity investment, the returns on equity over the medium to long term have been good. It usually beats the inflation rate in South Africa and in most Western countries. What are the weaknesses? Share prices can shift dramatically, which may result in a loss of capital, and shares are also subject to capital gains tax. Right, if we look at collective investment schemes, the strengths of that. Now, collective investment scheme is where you invest in various shares that's managed by a manager that manages that specific collective investment scheme's portfolio. It gives you a reduction in the initial capital outlay in order to gain access to the more expensive shares on the market, which was inaccessible to you. It's sharing of upfront and running cost between the various share portfolios, diversification in terms of asset classes and management company. A Manco is obliged by the Act to buy back the investors' units at any time, therefore making this type of investment very liquid. They need to pay you out within about 7 working days. Prices are listed in most financial publications as well as in newspapers, which makes it very transparent from a performance and costing point of view. And the funds are easily accessible, and all management companies are obliged to buy it back from you. The turnover or turnaround time is approximately 7 working days. If we look at the weaknesses of collective investment schemes, simplicity and the ease of accessibility may overshadow the risk of an equity investment. Most funds are exposed to the share market and therefore carry a fair amount of risk. If the insurer or the investor is not educated about the risk, he could suffer investment loss and poor returns. Investing in a collective investment scheme may be costly due to the high initial charges levied every time an investment is made, and these charges we will discuss in another slide. Right, if we look at more strengths of a collective investment, when viewed as a long-term investment, the returns normally outperform inflation. Investment may be made on a regular basis via debit order, eliminating the risk of trying to time the market. This is called Rand cost averaging, which means you buy a share at a low value or a high value depending on where the market is at that point. So you sometimes buy cheaper shares and sometimes buy more expensive shares, but it balances itself out over time. Units are purchased on a regular basis at differing prices. If the market is doing poorly, the price is lower and more units is then received for your investment. On the contrary, if the market is doing well, the price is higher and then you receive fewer units for the investment you make at that point. Studies have shown that investors using this type of investment pay method have less for their overall units, pay less for the units over the long run. So it averages out. Collective investment schemes may also be used in various other investments and offer clients flexibility in respect of structuring their traditional products, such as life annuities and retirement annuities. And lastly, but most importantly, investing in collective investment schemes is simple. It's an easy way for the layman to understand and offer investors opportunities previously not available to them. One of the other weaknesses of a collective investment is that the investors tend to withdraw their money more readily from this type of investment, which they then use to buy luxury items or overseas trips. And the fact is that the investment then get misused, by the investor. Right, if we look at bonds, that's now government or semi-government bonds, and the strengths of these bonds. Bonds pay a higher and steadier income than cash. Government is seen as a secure and safe credit risk. Bonds are generally less volatile than equities. Income is paid out regularly. Bonds can offer returns in excess of inflation. The weaknesses in the short term, bonds can make capital losses, although usually it's less than equities. Bonds may also be subject to capital gains tax, and the interest income is also taxable on bonds. If we look at property as an investment, it is secure, stable, long-term investment. Prospects of capital appreciation are high. Property investments provide you with long-term stable investment for the client. The risk is low and not very volatile. There is a lucrative second-hand market for properties. Paying off a bond can be seen as an effective after-tax return of a prevailing bond rates, and maintenance costs may offset against the rental income, thus providing effective tax structuring. What are the weaknesses? Performance is reliant on interest rates. Property investments are subject to capital gains tax. Income from property is taxable if you get a rental income. Property investments have high costs, for example, your transfer and legal fees. There are high maintenance costs involved in property. Property investments are not very liquid depending on demand, and the location can also be very risky. But you can also invest via property unit trusts, which then invest in properties, like big shopping centers and so on. Right, let's have a look at assessment criteria 2. At least 2 possible combinations of generic investment instruments are proposed to meet the specific needs of a client. So let's have a look at activity 1. Suggest 2 possible combinations of generic instruments for Mr. Snyman to address his specific needs with regards to the 1.925 million rand that he can realize from the sale of his small holding. What would you suggest? Make use of the 2023-2024 tax year information when you do your calculation. So you now need to go and look at the case study and answer this specific activity to earn the marks. Now, I would agree with the author of the case study to first pay the debt on the bank overdraft, as the interest rates are high on these overdrafts. According to the case study, 16%, but currently you can pay well over 25% on the overdraft. Car loans, interest rates 16%, but even they have increased of late due to interest rate increases by the Reserve Bank. Although the interest on the bond, interest rate 8.5%, is for now a reasonably low interest, that has also increased of late due to increases in our repo rate. I would, however, due to the act that we are in a rising interest environment, also suggest that we instead settle the debt. The return of 1.925 minus the debt of 1.425 will leave us with a balance of 500,000, which we can then invest. As Mr. Snyman has already invested in collective investments and shares on the stock exchange, you should be comfortable with either one of these investments or asset classes. Right, so to fully make use of his 23,800 interest exemption for the 23-24 tax year, he can invest about 200,000. Let's make it 198,333. Let's see if we divide that amount through 3. 23,000 divided by 0.12 in a fixed interest investment at 12%. He already earns interest of 1,200 per annum on a capital amount of 10,000 on his existing unit trust fund. This figure will then increase should he invest more in unit trust funds as recommended, because we're now going to add another 23,800, which will then push it up to 25,000. This figure, it is thus recommended that he invest about 200,000. We've rounded up to 198,333 in a fixed interest investment of, say, about 12% per annum. That's if you can get an investment at that interest rate. This is his existing unit trust, can be used as an emergency fund. The balance of 300,000, that's another 500 minus 200,000. We can invest, let's say, at 10% for 9 years on a fixed investment, and that should give him then a return of about 707,384. That's when we do the future value over 9 years at 10% on 300,000, that will arrive at that figure. Right, if we go and look at the next slide where we just summarize the information. So 200,000 in a fixed deposit over 2 years, which will give him about 24,000 interest. The 300,000 we invest in unit trust for 5 years plus. That will yield a small interest amount and a larger dividend amount of 7,500. The unit trust income has been assumed at 2.5%, of which 1/10 is assumed to be interest. Therefore, the 300,000 times 0.0250 equals the 7,500 in dividends. The alternative could be to use the 200,000 of the 300,000 and invest it into a moderate type of share on the JSE and invest the balance of 100,000 in collective investments. The total interest would then be 24,000 plus his 1,200 currently plus 750 in the new unit trust investment. That will give him 25,950 approximately. So that is now 24,000 plus 750 in the new investment plus the 1,200. Right, so if we now go and have a look at a tax calculation and how this investment solution would affect his tax, if we have a look at his current tax calculation, his current income is 732,000. He's receiving a traveling allowance of 54,000. If we multiply that by 20%, that gives us a 10,800 taxable amount. Interest in unit trust currently that he's receiving is 1,200. The new dividend unit trust and shares, from there he's receiving 3,600, and on his shares on the stock exchange currently he's receiving 4,500. That all adds up to 752,100 in gross income. His current dividends, if we add that together, 3,600 and 4,500, gives us 8,100, plus the interest of 1,200, that gives us a deduction of 9,300. Now, you can only claim 1,200 interest and not 23,800 because that's the maximum he's received. That leaves us with a taxable income of 742,800 Rand. And then if we take his pension fund deduction and the retirement annuity deduction, as he currently contributes, 51,240 and 6,000, that's 57,240, and we deduct it from the 742,800, leaves him with 685,560, which is now the taxable income, after we've taken off the exemptions and the deductions in the tax calculation. So now we go to the tax tables for the 2023-2024 year, and we go and calculate the tax on that amount. According to scale, he must pay 179,147 plus whatever exceeds the scale, and that was another 4,898 and 40 cents. So we discard the 40 cents, and that adds up to 184,045. We deduct, we then also deduct rebate that he can receive of 17,235 from the 184 tax payable, so that his final tax is then 166,810. Now, if you've done the tax calculation workshop, you would know and understand how to do this tax calculation. So please, if you haven't done it, you'll have to go and check, how to do a tax calculation. Right, in the next scenario, we have now looked at the current situation plus our new advice that we've added here. So it's still, the income is 732, the travel allowance is 10,800, but now the dividends and interest is increasing on our new scenario. So the interest on the unit trust altogether is now 13,200. Dividends is 18,000 on existing. The dividends on the JSE 16,500. Interest recommended on the portfolio of 750, and interest on the other one is 7,500. That gives us an interest on the recommended fixed deposit we said will come to about 24,000. So that now increases his gross income to 822,750. But you must remember that the exemptions has also now increased. So that's now 42,000 on dividends. And we've used the maximum deduction for his interest, which is 23,800. So the exemptions has increased to 65,800. That reduces gross income to 756,950 on the net income. Then we have also looked at his pension fund and increased it to the maximum limit, which is 65,880, plus his RA contribution of 6,000, gives us 71,880 that we can deduct. That brings us to 685 and 70. You would see on the previous calculation 685 and 70. The other one was 685, 560. So there was a very slight decrease of about 490 Rand in his taxable income. So even though we've added his gross income went higher, we've managed to get his taxable income lower. If we calculate the tax on that, it's 179,147 according to scale, plus a 489840. That gives us 184 and 45. If we deduct that minus the rebate plus the new medical fund we've added for him, allows him to deduct the tax credits of 31,875. We see that the new calculation now brings his tax payable to 152,170. So that's a saving that we have now worked for him in tax, although we've used some of that saving towards investing in a medical fund and in other options. So although Mr. Snyman's gross income increased by 70,650 to 822,750 from the 750 to 100, he saves 14,640. And if we look at the tax, which was 166,810, it's now down to 152,170. That also has saved him now in tax, and he has also decreased his taxable income slightly by 490 from 685,560, and has decreased to 685,070, which is that 490 Rand. So the advice that was given was therefore a very tax efficient solution, and we didn't cost him more on tax. We actually cost him less on tax after we've been there. Right, so let's have a look at assessment criteria 4. The strength, weaknesses, and cost elements of the proposed solution are evaluated against the client's need. So we are now going to look at the suggestions that we've made and what type of products will save him what as far as costs, risks, liquidity, return, taxability, and so on. So below you'll find a table with certain listed asset classes. The objective of the investment is mentioned, the cost, the risk, liquidity, potential return, taxability, and term related to the various asset classes. We provide you with some examples. So please complete the blank areas in your workbook. And here we give you the answer to that on the slide. So you can write down from here the information into your workbook. Here we've given you the asset classes, listed shares, collective investments in money market funds, property, and bonds. What is the objective of that specific asset class? What's the cost? What's the risk? The liquidity, potential return, the taxability. I'm not going to read through everything. And then obviously the term of the investment. Where does it fit in? Is it the medium term, long term, short term investment? Please work through this list. So when you make recommendations to your client, that you understand the various asset classes that you are going to suggest to him. Now, these are all your more conservative type of investments. So this is typically what the client in this instance would like to look at. Thank you very much. This concludes this session. The next session will then be specific outcome 3, that we will discuss applying knowledge of tax implications to a complex retirement planning scenario. We will look at the tax and the impact of tax on your proposal.